Welcome into Everything Money. We're so glad you joined us today. As always, Seth, Paul, and Mo are here talking financials, stocks. We're getting into more real estate this year, Paul. We're getting after it. Today we're talking about NIO. This is a very, very hyped stock. We talked about this. This is definitely one of the most hyped stocks around there. A lot of growth. EV, Nation, all the EV companies were drastically overpriced. Many of them have since fallen, which we told you they might. And to be careful. This is another one. We have done some videos on NIO in the past, months ago. Of course, some of the comments where you guys missed it. This is growth, yada, yada. A lot of hype YouTubers were definitely promoting this. They were 10xing this, telling you to dump a lot of your money into this. It has since fallen quite drastically, Paul. It's fallen in half since its January highs. Of late, they're announcing that they're delivering vehicles. In the month of May, they delivered 6,700 vehicles. Does GM do that in a day?
Let's see. I mean, what does GM sell probably a year? 8 million vehicles?
Yeah.
So per day, that's probably 2,500, 3,000 a day.
And so in the comments, Paul, they always say, how dare you compare NIO to GM? Because one has huge potential and one's 100 years old, been rocking it for a long time. But I digress. That number of 6,700 vehicles is down in April. So the chip shortage is affecting them. They're not making as many cars. However, the price of the stock is going up. And apparently investors don't really care. And
so in early May, it was 31. Now it's 38 or so. But if you look here, in April it was 43. So it's down a little bit. I think
today it's 41 and a quarter, and it's up about 7%.
So
based on this news.
So the point of this video is we use our 8-pillar analysis to look at companies. This has fallen a lot, Paul. We haven't actually talked about it since its great demise here. So perhaps we could look at this is a growth company with a lot of potential.
And one of the things I want to do today that's different is, we're creating in our software that you can have for like 80 cents a day. We're creating a stock analyzer tool that'll allow you to pick discounted cash flow model or multiple of earnings. So what I want to do is just sit there and tell people, okay, let's just actually look at the company. If you're to buy it today for its current market cap, and then also what the future cash flows have to be and what that return will end up. Because guys, at the end of the day, investing is just numbers. Your value today is a discounted cash flow of all your future earnings. So for example, if you were to sit here and I were to tell you guys, I'm going to sell you an investment that makes $1 a year for the next 6 years, what would you be willing to pay for that today? That's all investing is determining how much you're willing to pay for the future cash flow. Now, the question is, what is that future cash flow, right?
I think a lot of times we're misrepresented, Paul, and maybe we misrepresent ourselves at times.
Probably. I probably do a bad job sometimes.
I mean, I was going to say, people call us haters on this company, haters on that company. And it's like, guys.
I hate valuations.
That's just it. We had some Palantir drama, and it's like, I think Palantir could be phenomenal, but I'm just not. It's just about what we want to pay. It's so simple.
I love Amazon. I use Amazon more than anything in the world. And I would never buy Amazon at its current price. Yeah. Right?
Yeah, we say the same thing about Tesla too. I own one. Mo just bought one. Mo's girlfriend just bought one. We all have Teslas. It's just I'd rather not pay $4 for $1 when I want to pay 50 cents for the dollar.
That's a great way to put it. I think in Tesla's case, I think you're paying
$1,000.
I mean, you're not maybe not 1,000, but it's a very large number. Yeah. And for those, I understand when I first started investing, guys, I didn't understand that I'm buying a piece of a business. I didn't understand I was buying a piece of cash flow. Because the most common comment we get is, well, Paul, how do I see that cash flow? Well, when you own part of the company, you own part of the bank accounts, part of the debt, all these things. And as the cash flow builds, the company can distribute it as dividends or buy back shares or pay down debt, which makes your investment more valuable. So what I want to do today, Seth, is NIO is a company that's a little more established than most, right? I mean, it's not like Nikola or Workhorse. It has zero revenue.
It's got the battery swapping sort of garages over in China. They have a nice framework
and
set up.
So they're called the Tesla. What was that?
They are producing cars.
Correct. And even though 6,700 cars in 1 month isn't a huge number, it's something. Yeah. So I want to sit here and look at it and say, okay, so one of the things I want to do is, first off, when you're buying a company, a stock, I basically look at it and say, I am paying this much money for the company.
$60 billion.
So $60 billion. So what I'm going to do is I'm going to pull up Excel very easily. And I'm going to run an IRR calculation. And what it's going to tell me is what return I will get based on certain cash flows. So when I'm buying a company for $60 billion, my first year of cash flow is negative $60 billion. We're just going to put in 60.
What's IRR?
Internal rate of return. Great question, Mo. So basically, IRR differs from ROI. It takes the present value of all the future cash flows and it determines what rate of return you have to get that future return, okay? Then we're going to look at their cash flow and just determine, okay, what is it going to be for the next few years? So we go up to our Everything Money software, Seth. We go to our cash flow statement. In the last 4 quarters, the cash flow, free cash flow has been, so remember, free cash flow is cash from operations less your capital expenditures. So here they had about a negative $700 million, $715 million in free cash flow. Negative, okay. So my first year, so for the upcoming years, if last year they did negative 700 million, let's assume this company turns things around and they're going to start seeing growth in their free cash flow from here on out. So let's say next year they only lose 500 million in free cash flow. Since we started with 60 billion, I'm putting negative 0.5 since we're in billions here. Let's say the next year they break even. Then they go to 500 million in free cash flow, then $1 billion. Then I'm going to go aggressive and say they double free cash flow for the next 3 years. 2, 4, 8. Okay, so cash flow year 7. Now, in year 7, what's the company worth? We have to assign a value to the free cash flow, okay? Now everybody's gonna sit out there and say, oh, well, it's a growing company. But guys, at 8 billion in free cash flow, they've gotta be a huge company, a very big company. As an example, Seth, let me pull up Ford. Let's pull up Ford here and see what their free cash flow was last year. Their free cash flow last year was $24 billion. So in order for this company on the same margins to have 8 billion in free cash flow, they got to be 1/3 the size of Ford. So they sold, let's say Ford roughly sold 6 million cars. This is assuming then that NIO will sell 2 million cars in year 7. 2 million cars. Right now they're on pace for about 100,000 cars in a year. This is a lot of growth. Is it possible? Absolutely. So let's just assume that. Okay. Now, what multiple are we going to assign to this free cash flow? Guys, I'm going to go aggressive and say 30 times free cash flow. Because everybody's going to heart me and say, no, 15 is too low, even though the market should do about 15, etc.
I've been seeing these comments. Yeah, PE of 20, it's a new world, and PE of 25 should be standard.
Okay, correct.
Not that I agree with that. I mean, obviously, I don't know the numbers like you, but keep going.
So if we pay 30 times that free cash flow, that's $240 billion. So I'm going to add 8 to 240, and I'm going to do IRR. G1 to G8. Guess what, guys? 23%. Now, you guys sit there and say, well, see, look, this is amazing. If I buy it for 60 billion today, I'm getting 23% IRR. Now, here are the questions I have to bring up to you.
Go ahead.
What's the likelihood of all of this happening?
You tell us, because I don't know these numbers.
I don't know. All I'm sitting there saying to you is this doubling every year for 1, 2, 3, 4, 5 years, is that likely? I don't know. Remember, guys, everything you do in investing is about assumptions. I would just sit there and argue that a company that's doing 100,000 cars a year growing to 2 million in the next 5, 6 years might be difficult, especially with all the competition coming out there from EV, from every car company in the world. Every car company. I just bought the Taycan.
Including established car companies.
That's exactly it.
That's it.
I bought the Porsche Taycan and I'm supposed to pick it up today. These are all the assumptions we're making. If all these assumptions come out true, great, 23% is a really great investment return. That's awesome. But we also assume 30 times free cash flow. On well-established businesses, getting 30 times free cash flow is extremely difficult. Look at Microsoft. Microsoft's overall free cash flow, the company is worth 1.8 trillion. And their free cash flow last year was 54 billion. So that's 30 times free cash flow right there for Microsoft. A high margin, very, very sticky business. It's hard to compete with Microsoft and in an overpriced market already. So I look at this going, is 30 times free cash flow likely? Look at other car companies. What are they selling for in free cash flow? Well, and you're going to say, it's not Ford. Okay, but Ford...
I would think NIO would love to be in Ford's position one day.
Exactly.
In terms of
Ford,
cars.
Ford came out with that Ford Lightning, that electric truck, 70,000 orders in the first 5 days.
By the way, that car is beautiful. Reef wants to buy it.
Beautiful truck.
It's absolutely beautiful truck. So I look at this saying, guys, is it possible? Absolutely. Is it probable? I don't think with the future of where at 2 million trucks, guys, at 2 million cars, what's the average price for a NIO?
So it looks like the price starts at 65,000 for these.
Okay, so let's say the average car is 65 grand. They're going to sell 2 million of these. By the way, they're in China, where the average income is what per year? And they're obviously going to sell cars. I mean, guys, we're talking about $130 billion. So they have to go from $3 billion in revenue to $130 billion in the next 6 or 7 years.
Possible? Probable?
Possible, of course. Probable? I mean, what did Ford do in revenue last year? Ford last year in revenue, and by the way, what's the average price of a Ford car? Probably half of NIO's.
Oh, yeah.
Yeah.
You know what I mean? And Ford did revenue of $130 billion. Exactly. So they have to be the size of Ford in revenue. They have to be exactly the size of Ford in revenue in the next 6 years. Guys, my question to you becomes, is it probable? Are you going to go make an investment? I haven't even discussed number of shares outstanding. I haven't discussed any debt they're going to take on and to grow. I'm not going to discuss any of those capital expenditures they have to make along the way. I was assuming they get to free cash flow positive in 2 years. In 2 years. I don't think that's very likely. So for all of you who want to argue with me, I don't get it. Okay, then tell me your assumptions. If you want to tell me their assumptions are they break even in cash flow next year, then they double every year for the next, then I mean, even at 32 and then 30 times that, make them $1 trillion company. Okay, great. You just made 145%. Go buy the crap out of it. You work. But now you're making you're going to be making $32 billion a year in free cash flow, which is several times greater than Ford. It's just like, okay, I don't know what to tell you. This is just numbers, guys. It is just numbers, pure and simple.
Paul, I think this is a much more deep dive than
well,
everyone
this is
else
just doing
is
the
saying.
number. Yeah, exactly.
And so the point is, like, I think other YouTubers are just saying, well, if I buy at this price, I'm assuming with the growth, this stock ticker should go up and you'll make money.
And that's how stocks go sky high because people just hear this company. There's Howard Marks says there's 2 levels of thinking and investing. The first level is this company is a growth company, I should buy it. Second level thinking is everybody thinks this company is a growing company, therefore everybody's buying it. Therefore the price is probably really high, therefore I should not buy it. Same goes the other way. Everybody thinks negative about a business. This company sucks, I'm going to sell it. Second level thinking is everybody thinks this company sucks, it means their price is probably too low because everybody's selling it. So when we're talking about investing, guys, my goal for you is there's 10,000 companies out there to choose from. Find the 20 or 30 that everybody is missing. Find the 20 or 30 that don't have to hit their home runs for you to get. I thought the previous analysis to get 23% was very aggressive. I mean, find the ones that in your worst case, you still make 12 to 13% in your worst case, because then you're more likely to make 15 to 18%.
That's the thing. Even if you're going to look at the aggressiveness of it, why don't you just wait until at least let them break even?
Yes.
At least let them break even before you start getting excited. Why would you jump in on something that you have no clue what's going to happen? I don't think the company knows what's going to happen at this point.
Well, they sold 6,700 cars last month in a massive global rebound of the economy, and it's still down from last year, which is understandable from last year.
Yeah, of course.
But you would think, no. That was mid-COVID, and they still sold less cars than they did mid-COVID?
I guess so, yeah, May of last year.
Who was buying cars in May of last year?
Yikes.
I mean, guys, I just look at it saying,
apparently in China,
all I know is when I invest $1, I want to see how many dollars I get back in the future. I don't care what your goal for investing is, unless you have a process for momentum or chart reading that can tell you certain things. If you're an investor, if you call yourself an investor, that means understanding fundamental cash flow analysis. And this is just it. I'm just breaking it down in a very simple Excel sheet. All it is if I'm going to pay you, pick any sort of cash flow. If you pay $1 for something and you expect to get $1 a year for the rest of the time, for the next 7 years, guess what? You're going to make 99% return because every year you're getting your money back. Okay? If you pay that same stream of money, you pay $10 for it, guess what? You lose 8.2%. It's just math. It is purely math. And part of our software you can get for 80 cents a day at patreon.com/everythingmoney. Join the other 3,000 people who are doing it. Part of it will be Stock Analyzer tool. You will make your assumptions. It'll tell you the previous 5 and 10 years of every company based on earnings, cash flow, et cetera, shares outstanding, and tell you, give us your assumptions, and it will tell you what you need to pay for the stock today. And one of the other things it'll do is it'll also tell you, based on your assumptions, at some point in the future, it'll tell you, based on your assumptions, here are the stocks that fit the criteria you have set out today. We'll do the work for you. But your job is to find 20 or 30 good stocks out of the 10,000 that are out there to own and hold.
Mo, are people, as opposed to a long-term hold, are people day trading this?
Yeah.
People in the Bid-Ask Nation?
So I'm actually looking at this from a longer-term chart perspective. This doesn't mean multiple years on end. This means when the trend changes on you. But today, I mean, if you're obsessed with NIO and you have to buy NIO, this might be this is what you should be doing. You're coming up very nicely through the sweet spot. You got a great engulfing candlestick right there. Go ahead and buy the hell out of this. You have a bid-and-ask difference of 1 cent. This is perfect. This is when, if you want to be going and buying NIO, ignore all of that stuff because you're going to get smoked over there. It's just not.
We think you'll get smoked over
there.
here.
There's a high probability that you're going to get smoked. This is where you can go and make money on NIO. You'll be in at the right time. You'll be out at the right time. This is how you make money on companies like this that just have all of this hype and the future is very unknown.
Yep.
This you can kind of have a better idea of knowing because you don't need to know what company it is. You don't need to know all of that stuff. Go ahead.
And look at the last 5 years. 848 million shares outstanding, 1.55. That's up 80%. Ooh. Yeah, exactly. Guys, you think as they grow, they're not going to keep issuing shares, especially at these nosebleed levels? Of course they're going to. And in my cash flow analysis here does not factor that in there. And as they issue more shares, it makes the analysis even worse because you're getting a smaller and smaller piece of the pie.
Of course, that's just your opinion because a lot of people say issuing more shares is great for the company.
Well, those people who say that are really, really stupid.
Or they say it doesn't matter at all.
That's right. That's our take on NIO. Thanks for watching, everyone. We'll update you. We caught a lot of slack for saying we didn't like this when it was really high, and now it's fallen 30% on the way up. Interesting company. The cars are incredible, and it seems like
the cars are cool as
that's our take. Tickle the thumbs up. Check out the Patreon below, and we appreciate your support, guys. See ya.